Hey everybody! It's Monday, the 12th of December, and it's time for my weekly S&P 500 bond market and economic data update for you all. I meant to get it out this weekend, but if you saw my recent post over the weekend, Saturday was my wife's 50th birthday, and had a surprise birthday celebration for her, and I ended up getting back on the road yesterday, so just did not have time to put this together then. So here we are, day late. Better than not never though, I guess. All right, so this should be a somewhat shorter. I'm going to try to get through a little more quickly than I normally do. Still trying to work on getting the timing on it down. Um, Whatever the case, there'll still be bookmarks available in the video description for you. So if you want to skip ahead to anything in particular, or skip past something that's dragging on too long or something, you're welcome to do that. Also, use your pause button there if you need more time on any particular slide. Okay, so that's it. Let's get to the data. All right, guys. Started with the S&P 500, the bond market summary data here. Not much. As I mentioned earlier, not much activity going on right now with earnings. I think we had about 10 or so companies update this last week. Not going to be much more over the next 2 weeks. Only 6 this week and 9 next week. Minimal to no effect expected on my current value. Speaking of my current value and forward estimates for it, all of my numbers actually went up 5 points there. The four quarter ahead number went up 10 points. That's actually a good sign there. See if we'll probably start seeing more of the stronger upward stuff come in on the back end eventually, once the market does start, or once the economy does start to soften up a little bit, or tighten, loosen up, whatever you want to call it. All right, 12-month price estimate is up 15 points from 51.05 to 51.20. This is 1 year out. Expectation based on current earnings situation, just in case you don't know. Doesn't mean that I think the prices naturally should be up that high, but just based on earnings alone, this is telling me that this is where the price should be. As of right now, based only on earnings data, the target range for today would be 10 points higher than it was last week. 48.20 on the bottom end and 49.95 at the top end. So if we were in a rational market that wasn't concerned about recession or whatever, we could actually have prices up in that range. I don't think we're any time close to actually getting there with everything going on, but that's where, like I said, that's where we could really be just based on earnings alone. All right, we're up to 96% of the index reported now. Significant way through the quarter, as you see here. Only got those 2 weeks left, and then no companies expected the end of the quarter. And first week of January, only expecting 4 companies to report. Next week might start getting a little bit more of an uptick in the number of companies reporting over the next 4-week period. Right now we're down at the very bottom 19, barely even 4% of the index. I do expect that might pick up the pace just a tad next week, and then it'll really pick up the following week after that. All right, total expected change to my current value over the next 4 weeks, however, is -1. So that 49.30, I'm not expecting it to move even the slightest bit between now and next month. And look at the stocks and bonds. 10-year bond yield, or actually stock earnings yield for the S&P 500 actually went back up plus 10 basis points from 244 to 254. And 10-year bond yield also ticked back up some, though, from 351 to 357. 10-year, 2-year bond yield curve remains inverted in the same ballpark as what it was last week. And average long-term bond yield, this is the ones that affect the TSPG fund growth rate, that ticked up a little bit from 3.63 to 3.68. Ultimately, though, my recommended stock bond mix is going to be remaining at 40-60. All right, and last week's earnings updates only had 2 companies with $100+ billion market caps, basically larger companies that reported updates. Also, Oracle, I was expecting to update them last week. However, their update was delayed to this morning, or today, or this. I didn't catch whether it was this morning or this afternoon, but today sometime. All right, Costco, they were the first company that reported with $100+ billion market cap, and they missed slightly on their earnings. But the earnings are higher, and their estimate revisions were reduced like I would have normally expected. And Broadcom, AVGO, formerly known as Avago, that's why their stock symbol is that. They beat their estimate, and the earnings were up. Estimate revisions were mixed. The near-term recent quarter forward was up a fair amount, but the two other quarters, the second and third quarters out as they slid in, they were revised downward. So I call it more of a mix. And looking at the full list of companies that reported last week, I actually ended up just 6 of them. Broadcom and Costco, as you see there at the top. This is sorted by market cap rank. Also at AutoZone, Brown-Forman, Campbell Soup, and Cooper Companies. Cooper Companies is a health company, not the tire company. So, all right, for momentum buys, these are the companies that reported last week. This is a momentum buy screen for you. Companies with, actually doesn't matter what their size is, but looking for anything that reported earnings last week, which also still has a better than 10% earnings per share growth expectation over the next year. Only one of those 6 companies fit that screen, and that was Costco. There were no companies in there that meet my contrarian buy screen, or those with double-digit decline in earnings per share expected over the next year, so I will not be showing any of those. And we've got 6 more companies expected to report earnings this week. See here, I got 3 of the $100+ billion companies: Oracle, Adobe, and Accenture Public Limited. Also in there, Lennar Corporation, home builder, Nordson Corporation, and Darden Restaurants. Let's move on to the bond yield curve. As I mention here all the time, the long-term bond yields are more interest rate sensitive. Or they're more inflation sensitive, and the short-term yields are more Fed rate policy sensitive. I like to look at the 30-year here. As I always mention, we're down in about 3.8%, so we're right inside that 3.75 to 4 range that the current Fed funds rate is at. It was, as you guys might remember, up higher, up about 4.25-ish not too long ago, which was basically gave a pretty good clue that the bond market was pretty set on the Fed doing perhaps at least a 50 basis point rate hike in their meeting that actually starts tomorrow. They'll be setting that policy decision on Wednesday. We'll be talking more about that, of course. So it's gone back down though. Inflation data has been coming down some. So, and then we got some inflation data we'll be talking about in this presentation as well. The producer price index, or as we call it, wholesale inflation numbers. We'll be getting to that a little bit later here. This is a tight. These are tight conditions here on the bond yield curve. Not very friendly for bank stocks, and you might have heard that last week bank stocks actually suffered. Well, here you go. Bond yield curve is going to do that to you, do that to them with the way it looks right now. Like to see more of a step ladder, like going up from progressively higher from left to right. That would be ideal for economic growth. However, we're trying to slow down economic growth because inflation is too strong still. So that's what's going on there. And let's move on to the stock charts now. This is going to be the S&P futures chart from yesterday. As you see here, this is the daily chart, by the way. See here, we're down near the bottom of the price channel. We're also got the 100-day moving average right here, the green line. So we have possible signs of support right there to work with. We have the 10-day average coming down though. That's kind of creating a squeeze, and then add in the Fed doing its meeting tomorrow on Wednesday. That could be like a perfect timing for this thing to rocket in one direction or another. At least on a short-term trend, it seems like we should be expecting to flip and go back to the north pretty soon here. But it remains to be seen. There are plenty of other things to consider as well. Now we hit the bottom here. There's not a lot going on there. Not a great deal of volume there either. So that's a little bit more of a concern. I like to normally see some more buying activity, but I don't think that buying is going to come until after the Fed finishes their meeting first. So expect this to travel sideways perhaps for the next couple of days, sit there and test the 100-day average perhaps, get into that squeeze between 110, and I don't know. Well, we'll see how it goes. Let's move on to the weekly though. Weekly looks a little more on the concerning side here, right? I'm not going to lie to you here. Got what you call an engulfing candlestick here. That's basically engulfs all of the next 3 candles here, and in the opposite direction of what these previous 2 were. That could be a sign of, at least as far as the weekly is concerned, that we could be heading further south from here. We have the 10-week average right here, 38.71. Current, I think the week it ended, the price ended at 39.31. It could come down further to where the 200-week average is, which is 36.49. I'm not really convinced that it's going to get down that far. We might see a trend reversal, but you never know. And the one of the price channels, the bottom here that we were previously in, 34 to 30ish perhaps, I would say, is around where that bottom is at there now. So there's not a lot here though for technical support for the weekly chart, except for just the the 10-week average, which is not a very strong supporter, and the 200-week, which is a very strong supporter. Moving on to the crude oil futures chart, daily price chart here. Now I had to work with screenshots of this because I knew the market was going to be open by the time I got a chance to record this. I apologize here. So you can't have the crosshairs and other stuff going on here that I normally work with. But important thing is here we're seeing that the price broke down below. It's down below all of the moving averages now. It actually made it all the way down to 71.59. Guys, we have not seen crude oil prices this low since December of last year. So we're getting some new lows here for the year, and that's going to lead to lower fuel and gas prices, which can actually help the inflation situation in one way but hurt it in another. Lower fuel and gas prices, that has been high fuel and gas prices has been especially diesel fuel, has been the biggest driver of inflation because foreign nations put more heavy demand on the U.S. for gas and oil. Oil, gas, and diesel, whatever, because of embargoes or not sanctions against Russia. They need their petroleum products, but they don't want to buy it from Russia. So, yeah, they put more demand on us. That drove our prices up, and on top of that, also have shipping costs as well. It costs more for shippers to send product to store shelves and stuff because of the cost of fuel. So that has been like a twofold factor in inflation growth, and that's been a problem. But fuel prices are going back down now, and in a way that's a good thing. That'll definitely help inflation in one way. However, lower oil, gas, and fuel prices is also going to stimulate demand on the domestic consumer market, and which sounds like a good thing. But when we're trying to get inflation back down into a target 2 or 3 range, and we're still up at 7.5. or over, actually 7 3/4 what it was at last month. That's maybe a little bit too early for that kind of thing going on. But whatever the case, I'm happy about this. It'll at least help to some extent, I would think. Maybe see a little stability here, perhaps, and give the overall inflation numbers a chance to come back down some more before continuing down. I think would be a good thing. And looking at the weekly chart for crude oil futures. Yeah, as you see here, here's where our lows were from right around the end of December. That's when it spiked up. We didn't get much lower than it. Actually got down into about the mid-60s in the middle of a week, and then it closed out that week up above 65. We're on our way down there. I don't know if we're going to actually make it this far down. We might. I know they were trying to sell, making a deal with Russia on $60 a barrel oil recently, so there's a possibility they're kind of eyeballing that $60 range. But I think this 200-week average here, somewhere in that ballpark, might come more strongly into play there at the about $65 a barrel. We'll see how it goes. But whatever the case, like I say, it's at least a respite from the high gas and fuel prices that we've been seeing over the course of the year. And looking at the dollar index, this has been a key driver. This goes hand in hand with inflation. As inflation goes up, dollar value goes up. As inflation comes down, or is expected to drop, comes down in value. As you see here, it dropped a fair amount here in November. Looks like it's kind of flattening out there. Have the 200-day average here. It actually went right through it, and looks like it's testing it for resistance now. You got both the 200 and the 10-day averages right there helping to try to push it down now. And it does look like it wants to continue down. I don't know how much further we really need to go on this, to be honest with you. I don't think it's really needs to go much further at all. We'll look at the weekly chart for more information on that, though. Now, this is going to be a bad thing for this is a good thing for the iFund for TSP participants, because as the value of the dollar goes down, that means the value of foreign currencies goes up. And TSP iFund invests in both the ETF, a stock index fund that is populated by companies that are from a number of other countries. If you look at my last weekly report from last week, I have ETH-PMI in there. If you look at that chart there, you can see which countries are involved in that, or for the most part. So this has been a good thing for iFund here. You probably might have even heard that iFund performed very strongly when this happened, and this has a lot to do with it. Kind of trending a little sideways now, though, so I don't know if we're going to continue to see strength in the iFund with what's going on here. We might see lower. Like I said, let's take a look at the weekly, though. On the weekly, it's not. I wouldn't say it's looking the greatest for iFund, because we got the 50-week moving average right here at 103. Current price was 104, high 104, almost 105 is what it closed the week at. I'm looking right over here. Or you can also look at this if you can decipher the colors. So we might get a bounce there, and if we get a bounce there, it's not going to be good for TSP iFunders. Okay, so now might not be a great time to get in iFund. Now, if it ends up punching through this 50-week average here and working its way, continuing down through the 100 or 200 down here where the green and blue lines are, okay, then we might have something there for more iFund performance in the near future. But 50-week average could be a pretty strong possible support point, so I wouldn't make a strong bet that it's going to make it down this far. It might, like I said, inflation coming down, it might help push it down below the 50, so there is that possibility. We'll have to see what happens, though. And moving on to the week to the economic data, we're going to go with our weekly jobless claims information data here. This is the initial claims. Actually was up a little bit from last week, not by much though. Still below the 20 November numbers though. And the previous week's number just revised upward 1 point from 225 to 226. Hasn't been much revision going on here with any of these. As you see, it's all been upward by just 1,000 on every week. So really, that's not too bad. And given the economic conditions, it's I hate to see people lose jobs, but helping get that inflation down some, like I said, under control. We do need something here. Hopefully we just don't see it get up here into these July range here, up above 250. We'll see how things progress. But so far, at least there's at least a telltale sign here of some stability, if not, even if it's trending in the wrong direction. Somewhat stable as far as layoff rates is probably concerned. And looking at the continuing jobless claims here, they are actually up, as you see here, up above 1.6 million. I haven't had a number that high since I started keeping a record of this data here. And you see here the number is getting further and further up from the 4-week and 8-week moving averages. That's a concern there. Also, well, it did revise. The previous week did revise upward by 1,000 as well, or 1,000. So small change there. The fact that this is going up says that it's getting harder and harder for employees to, for workers, whatever, to find work elsewhere, because they're spending a little bit more time here on the continued unemployment line before they get new jobs. And to give you a perspective view on the continuing jobless claims, because it is trending in the wrong direction a little bit, so I want to get an idea, where is it historically sat, and where does it get to when we're spiking up, or when we're in bad shape. So it seems like in that maybe 2.5 billion range or so seemed to be a norm right there between the two, between the .com and Great Recessions in the 2000s. We got down to actually, at best, now we were down here probably around 2 million-ish or something along that line. Maybe not much higher than where we're at right now. So we're looking really good. We're just coming down from, we're coming back up from what is probably a historical low. Now, like we've never seen continuing jobless claims as low as we've seen them lately. I'd have to look further out and download data to see where we really stand compared to historical records. But I'd say this is probably going to be down here at or near the bottom of what we've ever seen. So not necessarily a bad thing if we see the unemployment continuing claims numbers come up a little bit up as we get closer to 2 million. If we start getting up closer to 5 million, that'd be a definite concern though. So let's hope we don't get up that high. Yeah, and I'm going to summarize what economic data came out last week. The ISM non-manufacturing, that should be NMI, not PMI. It's non-manufacturing index. PMI would be acronym for Purchasing Managers Index, for those of you guys who don't know. I'll be covering that in greater detail in a minute. Here's a lot of good information you can get out of that. That's forward looking too. Gives you a really good clue what's going on with the economy. What this is basically telling us here is that the last month the last reading here was actually stronger than last month's reading of 54.4, and it was also above the consensus estimate. But it is expected to drop back down below last month's reading next month. This is basically, I would say, mild moderate growth. This is definitely solidly moderate growth. We'll cover that more detail in a few though here. Balance of trade summary here. Previous month was a deficit of $74.1 billion. The deficit actually widened to $78.2 billion. But it was better than expected. They were expecting $80 billion in the hole. And next month, the forecast is for $73 billion deficit. So it's expected to improve next month. And looking at last Friday's updates, the producer price index, month over month, I might have heard something about that. The consensus was for plus 0.2%. They actually got 0.3. 0.3 is not bad at all, actually, especially on the wholesale inflation, because a lot of the inflation that producers see does not get passed on to consumers. So generally expect to see lower numbers on the consumer side than the producer side. And I'll take 0.3 all year long. Yeah, that is just perfectly fine there. Forecast for next month is also 0.3. We'll cover that also, some detail here in a few. And then the Michigan consumer sentiment, that actually came in stronger than last month. 56.8 last month, 59.1 this month. It was also above consensus estimates. However, it is expected to drop back down below both this month and last month's numbers a month from now. All right, this is a summary of the ISM services, as you call it, or non-manufacturing index data here, like I mentioned. So you'd like to see green. Green is good, strong growth. Red is not so good. Kind of in the middle there. New export orders, new export orders and imports looks concerning, but we'll get to that in a second here. Overall, the index is in still moderate growth, I would say. We had a 1 month not quite as strong in October, but it's solidly in the same range as where it's been since July. So actually, for the most part, for most of the year. So this actually looks pretty healthy. Business activity, that is up. Basically, these companies on the services side are becoming more productive and efficient, is what that's telling us, and that's a nice strong number there. New orders component, still seeing moderate growth there. That's a good that's a good sign there for at least some economic strength, but maybe a little bit of ammo for the Fed to use for another rate hike. So that's something there to also be concerned about. Good news can be bad news, unfortunately, with this, with what's going on here. Let's see. All right, supplier deliveries are down a little bit. Kind of down in that same range that we were in August and September, though. And inventories, these are, we want to see them on the decline, mildly like they are right now. If they start turning positive, that's more of a concern, because if inventory starts going up, it's more of a question of, are they going up because of weak demand or something else, or did we just get some supply bottlenecks cleared up? So we know we have some waning demand with the Fed policy actions lately, so I'd be a little bit more concerned right now with it going into the positive based on that. Be concerned that would just be a sign that demand is weakening and could put us more risk of a recession. Price though, price growth, the sentiment, about 70% of the companies that were surveyed are still reporting price growth. That's still a pretty fair amount there. It's still a driver of inflation. I'd like to see that number come down some more here, without seeing some of these other numbers suffer with it. Backlog of orders, again, this is what's going on here. Is this a result of weaker demand, or is this a result of supply chain bottlenecks getting cleared up, or is it both? This data alone cannot tell us, but it definitely gives us questions that we could go looking for answers for elsewhere. New export orders, they're down a lot. Don't know what's going on there. I'd have to, I don't know, maybe the GDP data will give some data. We had actually good strong. The last two GDP readings, the first and second month readings for the current quarter, were suggesting that new export orders were doing well and imports were down. But this particular report here is suggesting the other way around now. Exports are down a lot and imports are up a lot. Now, imports, maybe you might expect some strength there because of the holiday. If we look here at December 2021, yeah, it did spike upward here compared to everything else before coming back down. So that could just be seasonality because of the holiday. What happened here in December? November, it's more of a spike in November than it was in December. Probably, yeah, could have had something to do with Black Friday deals or something. I don't know. But somewhere in the ballpark, we do expect an upward spike in activity related to the holiday shopping season. It just maybe started later, or actually, no, November is around the same time. So really, that's to be expected, I guess. And that's a pretty strong number there for imports. That means consumers here probably still have a fair amount of money to spend. And we still got 13 industries reporting growth and only 3 reporting contraction. So overall, we're in pretty good shape here on the services reports. It's considerably, markedly better than what the manufacturing side's report came out as. I talked about the manufacturing report last week. I did not like one bit of it. It looked horrible, to be honest, in my personal opinion. This is definitely a lot better, kind of a yin to the manufacturing side yang, I guess you will. So yeah, there is at least some positivity here to work with as far as potential for a soft landing on the Fed's rate policy plans. And getting a 12-month perspective on the U.S. balance of trade. As you see here, the trade gap widened the last 2 months. However, it was in an uptrend over the last 6 months prior to that. And I mentioned in the summary, they are expecting it to narrow again next month. So we'll see how things go there. And looking at wholesale inflation, month-over-month data here, just from the last month to this month, or October to November, plus 0.3%. I mentioned I'll take 0.3 all year long with wholesale inflation. Now, there was some concern about the core inflation being at plus 0.4, which is, okay, it's a little on the high side, but it's really not far from being where we want it. Actually, 0.2 to 0.4 is what I always say that I like to see. So it's on the high end of what I would say being okay. Either way, we're definitely seeing lower numbers the last 4 months, and actually 5 months in a row, than what we saw all of the earlier part of 2022. So this is good news here, guys. And putting that same data, the price index in here, we ended up at 7.4% wholesale inflation growth rate on a year-over-year basis. I think on the trading economics side, I think it was suggesting it was down at 7.3, but my number's coming out to 7.4. The average, the slope here, I'd have to show you on the 12-month price chart, or 12-month chart on the trading economics side. I did not save a screenshot of that, but it does show some signs that possibly the inflation is picking up a little bit again. So that's going to be some ammo for the Fed to put some more rate hike in there, at least a 25, perhaps maybe even a 50 basis point hike this week. So yeah, they want to keep it down and under control. We don't want to see this start getting back out of control, pushing back upward because of people's money catching up with prices here too much. I hate to say that. Let's at least get the inflation numbers down here. I think even at the current growth rate, the average, because now these numbers here, the shallow basically covers that whole 5-month period. Again, I don't have the chart to show you what it looks like on a year-over-year, or actually on the price, just price-based. But this 5-month period here, actually this 6-month, you can see a solid trend there. Basically from here to here. And the shallow was basically comparing the average rate of change per month of the producer price index. It's the actual price thing between here and here. And then the strong side will be from where the zero is to there, if I were to show you. I'm just kind of getting an average, like what's the fastest growth rate over a noticeable trend, and what's the slowest growth rate over a noticeable trend. The longer term noticeable trend is from June to November. The fastest trend over that same period is from August to November. So that's where I'm getting that information from. Going back to this, so now that you have this explained, average is out to 269. We'll just say 27 cents. If we project that growth rate out for the next year, this is what we end up with. Should end up with year-over-year number just a tad below 7% for the December reading, and should start off 2023 with just under 6%, and then just under 5% in February. End up working our way down into below 3%, in that 2 to 3 range that they want to see by May of 2023. Not too many months out there. It's 6 months away. So yeah, maybe just over 6 months away. Might even get a little sooner. We'll see. And looking at consumer sentiment data here, this is actually another good thing here. It's usually we see the number drop down to its lowest point at the bottom end of a recession, and then when it starts to pick back up, it tends to coincide with what stock market increases and economic growth are as well, and it's trending upward. Kind of sideways right now, as you see there. November, it was a little bit on the slower side, but it seems to be pretty solidly in that 58, 59, almost 60 range. So not a problem at all. Keep it right in that same area where it's at now. Let the inflation numbers come back down to earth, and once they come back down to earth, like to see this come back up, eventually work its way back up to closer to 100 eventually, maybe even over 100 if all goes well. Because at the top end of bull market periods, we do tend to see this get up above 100, 105ish even. Somewhere in that ballpark is usually where we find it topping out at before we go into bear markets and recessions, typically. And looking at that same data here plotted out on a table, as you see here, we had the low point in June and July again. The November number, which I just figured out, revises every month before doing this report. It revised up just a little bit there from 54.7 to 56.8. So it's basically telling you that the market, that consumers are actually a little bit more upbeat in sentiment than what was previously reported. So we'll see how this 59.1 goes next month. Is it going to revise upward as well? That would actually be a good sign for more stock market growth if that does. Looking at insider trading information here, sell versus buy line courtesy of wellwisdom.com. See here, we're still kind of getting closer to that bull line. I think it briefly dropped into the bull line last week, but it came back up with new data coming in. It still looks like it wants to bias toward the bullish side, though. So it tells you that insiders, with the money and the company managers seem to be in a buying mood more than a selling mood right now. Not strongly in a buying mood, but they're definitely leaning more on the buy side. Looking at the DAT truckload freight data. Spot load posts surged a lot from last week, but now keep in mind they had a shorter week last week for previous week for Thanksgiving. Spot load posts surged upward also for holiday shopping. You can see where the big strength right here is on the van loads available, and that's of course for holiday shopping. It's to be expected. Spot truck posts are also up a fair amount, but nowhere near as fast as the spot load posts are. Well, if they were on the same numbers. We don't know what the actual numbers of trucks and numbers of loads are. So there's like 6 times as many trucks as there are loads, which I doubt to be the case. 28% increase in trucks available would actually translate to the same number of loads getting increased then, or actually be about 7 to 1 truck to load ratio would cause that to be a wash basically. But I'm pretty sure they're not that far off. I would expect that there are more trucks than there are loads, but not 7 times as many. So this was all expected here. Had still some pretty strong, actually, growth on all of them. Even flatbed loads are up, over 50% from last week. But again, we're coming off of Thanksgiving, so I don't know. I'm not really. Let's see how this goes. This is just a naturally volatile period. I don't really trust these numbers here. I don't want to really work with these. So we'll go ahead and move on though. And looking at the trend on the freight rates as well as average fuel prices, DAT reported that the freight rates went back up a little bit from all those load posts, but the numbers I got off their site this weekend were down from what I got the previous weekend. So I don't know. Maybe I don't look at this every single day, so maybe they did drop even lower than that before they went back up. Either way, van loads are actually still up above the 26th November, the week of Thanksgiving numbers here. So that's a positive. Just there was a surge on the 2nd of December. Maybe I'm a little bit, maybe this is a little bit premature data. I don't know. Maybe the numbers that they were referring to were these here, especially the van load numbers. Again, that's holiday shopping going on there. Otherwise, flatbed and reefer are both trending downward. Otherwise, reefer is back down to that 6th November low, 273 a mile. So it's not such a good thing there. and we don't want to see flatbed struggling, because flatbed is always a good telltale bellwether type sign of what's going on with the economy, since most of their business depends on farming, construction, and military. And especially that construction part there, you start to wonder if the freight rates are going down. That means their loads are going down as well. And if their loads are going down, how much of that's coming from decreased construction activity? That would be my concern. Not such a big concern if it's from military movements and stuff, but because that could be a sign that we're more in a peaceful situation there. Average fuel price, that dropped a lot, 18 cents a gallon. This is diesel fuel price here, guys, and whatever diesel fuel does, you can probably expect your gas prices to do the same. Down 18 cents a gallon over just a single week period, and it was down 9 cents a gallon the previous week. Crude oil price I mentioned earlier is continuing to drop, so I'm expecting this 496 to drop even more by next week. So looking really good there. That'll help to some degree with the overall inflation data. And looking at this coming week's inflation data that's expected to be reported, got consumer inflation coming out tomorrow on the 13th. Currently, the consensus is for it to drop a little bit, not by a lot, but it is expected to drop from 6.3 to 6.1 on the core side, and then overall, it's expected to drop from 7.7 to 7.3. I believe my numbers were expecting a little higher than that. I think I was expecting like 6.4 or something like that on core or whatever. I can't remember. I'd have to pull up my data. But I believe they were expecting lower than what I was expecting. So I don't know what these numbers are going to come in as well as they are, but I don't know. Again, lower fuel and lower oil, petroleum, we'll just say prices could factor into that. I'm looking at it more of what data already does exist, and if it's if these prices are coming down subsequent to like these petroleum prices are coming down subsequent to my data that I'm working with, then okay, that might be more viable. We'll see though. All right, Wednesday, that'll be the Fed interest rate decision. I mentioned the Fed meets tomorrow on Tuesday. It's a 2-day meeting, and then on Wednesday at noon, that is Mountain Time. So about 2 p.m. Eastern or 11 a.m. West Pacific Coast time, Pacific time, whatever. About that time is when we expect to hear from the Fed on what they're going to do. Consensus is that they're going to do a 50 basis point rate hike, and they're expecting it'll stay at 4.5% on after that, at least for the time being. Also have FOMC economic prediction. That's part of that. This is all part of their press conference. And then on Thursday, have this retail sales reports. Last month it was strong. Again, the holiday shopping season coming in. The consensus is for a minus 0.2% month over month. So they're actually expecting it to slow down. But I don't know if I'd expect that. But then again, especially with Black Friday. And just starting off the holiday shopping season here, I would have normally expected this to be up from a more fair amount from the previous. So I'll be surprised if that comes in at negative 0.2%. I say, what do I know though? Well, that's going to be a wrap for this week's report. I hope y'all got a lot of good information out of this. And so as you see here, next week I'll be covering the usual earnings, bond market stuff, as well as the Fed policy decision, consumer inflation. Should be a pretty nice and easy week as far as data is concerned. As I said, it'll take me some time to try to get this down to where I can get these presentations down to a shorter time frame for you guys, for these guys who don't have the attention span. But if you guys have the time to listen and want to learn something good, useful, I hope you made it all the way through this. And like I said, the bookmarks there in the video description should definitely help as well. All right. Not all that. I wish you guys. I hope you have a great week, and we'll see you on the next week's update. All right. Have a great day.